Follow me here first. Inflation is not just happening in US, it's also happening here in Singapore, as you can see in this article over here. Theoretically, if inflation increases, interest rates increase, correct? And since we know REITs borrow money to buy properties, they actually have a maximum gearing limit of 50% here in Singapore. That means that if interest rates go up, their cost increases, correct? It's like you buy a house, you buy a property, you have mortgage costs. Interest rates go up, you actually have to pay a bit more. Same with REITs. If that interest rate goes up, that means that they will have less to pay out to investors like you, correct? This is an example of Mapletree Commercial Trust. Interest rates came down in 2020. Net finance costs came down by 2.4%. Now, if interest rates go up, the net finance costs conversely will go up, correct? This video is sponsored by SYFE, and the views I'm going to present to you are solely for my own, which is surely REITs won't do well if inflation increases and interest costs increase, correct? Now you're in for a treat. Today I'll be presenting you some very interesting findings, and if this topic interests you, continue watching on. Hi guys, welcome back. REITs are sensitive to interest rates not just because of the borrowing cost, but because of this other crucial factor. REITs are often an asset class to provide dividend income. And for dividend investors, they're always comparing REITs against bonds, against fixed deposits, for example. Now, if interest rates increase, fixed deposit rates naturally go up. And that also means that to an investor, they'll be comparing, hey, REITs, the amount I can get, is it much more than fixed deposit? If not, why invest in the REITs? I think that's quite self-explanatory. If the Singapore Savings Bond is 3.5%, for example, why in the world would you buy a REIT at 3.5% dividend yield? It would not make any sense. What happens next is that the REIT must produce 5% dividend yield, for example, to appear attractive as an investment class again. And let me give you an example. KEPPEL DC Reit. KEPPEL DC Reit is right now about $2.60 and it pays 9 cents in dividend. The dividend yield is 3.5%. If the dividend is still at 9% the following year, and the investors right now expect 5% in terms of yield before buying such a REIT, does that mean that the price needs to drop down for the yield to increase? That's correct, right? Theoretically, KEPPEL DC Reit needs to drop to $1.80 to produce 5% dividend yield. Now that's a hypothetical 30% drop from $2.60 right now to $1.80. A whopping 30% drop because inflation caused interest rates to increase in general, and the investors need to be compensated more yield right now. But wait, is it all gloom and doom? I share the same questions as you, and therefore we've actually done the research for you, done the homework for you, and invite you to smash the like button early because it's taken our team many hours to do so. Rising interest rates have actually happened many times in the past, and this chart actually shows how REIT performs during sustained periods of rising interest rates. The data is hardly conclusive that when interest rates go up, REITs go down. In fact, it can be argued that REITs showed some of the biggest gains in periods where interest rates increase. But this chart is actually pretty outdated, and from a historical standpoint, some of the information may not be accurate as of current market conditions. So I have a slightly newer chart to show you also. This is actually a chart showing the correlation between REIT total returns and 10-year treasury yield. And if you have done statistics before, you know that correlation 1 means totally aligned. Correlation -1 means totally opposite. So what do you realize? The correlation is not consistent, correct? It also suggests that it's more correlated than not, which means when interest rates go up, REITs go up. Now the question is why, and I've actually two reasons for you. The first reason is actually REITs can increase the rent they collect, unlike bonds. Bonds, the amount of coupon is fixed, which means that when interest rates go up, bond prices have to come down. But REITs own properties, and while some leases are locked in for many years, when economies are good, it also means an opportunity for the REIT manager to negotiate rent upwards. I do understand, however, now that there's phase 2 heightened alert, which may affect businesses in one way or another, but if we were to look super long term, this is just a phase that we'll get through together as an economy, which means this can actually be an opportunity for you to position your portfolio ahead of the real recovery in the market itself. So back to the point of negotiating rent upwards, for example for office REITs such as Suntec REIT, which I'll cover for you in this channel quite soon, and CICT, for example, which all own grade A office towers. And when economy is good, demand is good, naturally they can also increase the per square foot rent they collect. And what about for malls? Fraser Centrepoint Trust, Mapletree Commercial Trust, these REITs actually collect tenant rent from shops like F&B outlets, like fashion outlets. I believe that once this pandemic is over, they'll eventually all do better. What about for hospitality REITs such as CDL, Hospitality Trust? You know, when we start opening borders again, I know it's been quite a long while, we should be optimistic that hotel rooms will start getting filled again. Their occupancy will be better, their profits will be better, which means that they will eventually reward shareholders with better dividends. There are so many different REIT sectors to choose from, but according to DBS's research, they believe that industrial REITs have the best growth trajectory currently. So when it comes to SYFE Reit Plus, there is actually an allocation about 41% currently into this industrial REIT sector, where you'll see names such as Mapletree Industrial Trust and Mapletree Logistics Trust. The second reason is good REIT managers can always provide value to shareholders. Now, in a good economy, the property value goes up or down. It goes up, correct? Which means that a good REIT manager can actually sell out properties and cash in on gains. And to look for yield accretive deals during interest rate increments is not easy. But good REIT managers with a strong sponsor can source the world for deals. For example, Ascendus REIT moved to Australia in 2015, buying some industrial properties over there. And in 2021, Ascendus REIT has actually purchased more than 900 million worth of European data center properties. Conversely, interest rates are low right now, and yield accretive properties are all over. And good managers are actually looking for deals and leveraging up right now. Let me give you an example. This is actually Mapletree North Asia Commercial Trust. What you see over here is a presentation of why they've bought into Japanese property, because the net property income spread over the 10-year Japanese government bond is significant. I have more information for you. This is actually a list of REITs who have actually acquired yield accretive properties very recently. In just this 1 year, a total of 7.6 billion worth of properties have been purchased. If you look closely, there were actually so much corporate actions such as perpetuals, private placements, and especially right issues. As an investor in REIT, there are actually some corporate actions that you need to take action on. And that's where actually today's sponsor with their product, SYFE Reit Plus, actually is truly outstanding. In this portfolio, Reits are auto-subscribed for you, and Reits are typically offered at a discount. And this is my holdings in Mapletree Industrial Trust. And what you see over there is I subscribe not just the 675 allocated to me, I oversubscribe by another 25 to round up to 700. Fully exercising my right options. Now, in my own SYFE Reit Plus portfolio, I saw that they have actually sold off small amounts to generate cash to subscribe to this rights issue. So it was totally hassle-free. Not only that, dividends are auto-reinvested for you, and if you're looking to compound your monies, having dividends reinvested is the way to go. If you're ready, look for my referral links below. It'll give you a 6 months free in terms of the portfolio management. Or if you want more information on SYFE Reit Plus, follow this previous tutorial I've done. This is a full breakdown of SYFE Reit Plus. What are the steps to open an account for yourself, and the difference between the 100% REIT portfolio and the one with risk management. Both of these portfolios give you exposure to the best REITs in Singapore, such as Ascendus, such as CICT, such as Mapletree Commercial Trust. So one portfolio diversified and managed in accordance to the IH index itself. So these are the best REITs in Singapore. If you buy it individually, it's so much more difficult. Why not get a portfolio, let it properly be managed, and then deliver returns to you as an investor? So if you're curious, find out more on that tutorial. It gives you really the full breakdown you need. And with that, I'll sign off from here and see you there. Take care and